So what we're going to look at now in learning objective 2 is two methods of internal control. We're going to look at the bank reconciliation and we're going to look at petty cash funds. And these control techniques are obviously focused on controlling cash. Cash, as I mentioned earlier, is the most vulnerable asset on average. So for example, while diamonds are usually worth more per kilo than cash, cash is the easiest asset generally to transform, to transport, to use for other things. Diamonds, you need to know where to take them to resell them. You need to get someone to buy a relatively high value item. So therefore, they're not as easy to misappropriate, steal, do bad things with than cash is. So we focus here on how to control cash. So as I said, we're going to look at the bank reconciliation and we're going to look at the petty cash funds. So let's start with the bank reconciliation. So what exactly do we do in a bank reconciliation? Well, the first thing that we do is we reconcile the bank balance from the bank statement to the actual cash balance in the business. So what does this actually mean? Well, what it means is that we look at what the bank is telling us we have in our account. So if you go on to your online banking account with, say, CommBank or NAB or ANZ or Westpac, you will find what your actual bank balance is. So that is the amount the bank is telling you you have in your account. Now, in a business, of course, you know that we record our cash balance in our T account, which we consolidate into our balance sheet. So in that particular case, we need to reconcile those two different things. We need to reconcile what the bank is telling us we have with what we believe we have in our T account in the business's records. And you're going to see shortly why there may be differences between those two amounts. We then want to reconcile the company's book balance to the actual cash balance. And again, some of you are going to be wondering, well, why would the company's book balance of cash be different from what their actual cash balance is? And we'll see why that's the case. And when we actually discover information is essentially missing from our records, then we will adjust the company's book balance to its actual cash balance amount. Now, there's a few terms that you need to be aware of as we move through this particular learning objective related to the bank reconciliation that relate to items that we're going to discover that are necessary to reconcile the amounts that we're looking at. So the bank statement amount with the amount in the records of the business. And the first thing that we need to be aware of is what a credit memorandum is. And basically a credit memorandum is an addition to cash on the bank statement for items such as the collection of interest. So basically that means it's an amount that increases your bank balance in the bank statement. Gives you a higher balance. Now remember, of course, the bank gives you their version of accounts. So remember, the bank owes you the money that they have in your account. So they record that as a credit because for them that is a current liability that they need to expect, they may need to at least pay you within a year. So that's a credit liability for the bank. For you it's an asset, of course. For them it's a liability. So of course any additions to your bank balance, the bank credits because they're increasing their liability they owe you. The debit memorandum is where, of course, the bank reduces your bank balance. So, for example, bank fees. So if the bank takes, for example, $5 a month, they will issue a debit memorandum which reduces the balance of your account. So, as full-time students, remember that typically banks charge full-time students no bank fees. So if the bank is charging you some bank fees, you may want to investigate that. Okay, now these are two key areas we need to look out for when we're analyzing our bank statement. And in particular, we're looking for these two types of things that we may not have been aware of until we look at our bank statement. Right, now, In addition, we also need to be aware of a number of things that may not be showing on our bank statement, but of course we have recorded in our company's records. That is, we have recorded them as a transaction, and so therefore that information has been consolidated into our T account. The first is a deposit in transit. So a deposit in transit is a deposit that has been made by the company but has not cleared the bank as of the statement date, right? So this essentially means that we have deposited a particular amount into our bank account. However, it has not cleared. So that is, it is not showing up in our account. So banks usually have a processing time. So if you deposit an amount of cash into the account, the bank may take a business day for that to be reflected in your records. If you take a check to the bank and deposit, the bank may need a couple of days in order to clear that check. So these are deposits which increase your bank balance that are in transit. So they are essentially pending processing by the bank. We also have outstanding checks. So our outstanding check is where we, as a business, distribute a check, but the company or organization we distributed it to has not cashed it out, essentially. So these type of checks are good in a way because it means we've given a supplier a check to pay a bill, but they have yet to cash it, so it means the money is still in our account. Now, you can reasonably assume that, of course, that money will be taken out reasonably soon because the supplier wants to be paid. So that, again, is another one that's pending that we expect will come out of our account balance at some point in the near future. We also have the last one here, which is a dishonored check. And as a business owner, we really hate these types of things because it basically means someone has given us a check. We have given it to our bank. The bank has attempted to clear it and transfer the money to our account. However, when they attempted to clear it, they discovered that the person that wrote the check doesn't have sufficient funds to cover it. So not sufficient funds. And so therefore, none of that amount that was written on that check is transferred to our account. So of course, as a business owner, we follow this up, we investigate this, but the end result, at least in the short term, is that we didn't have any money that we expected to be transferred into our account that relates to that particular check. Okay, so if we move on to the next slide, and we look at the bank reconciliation. So what we want to do here is we want to reconcile the bank balance, so that is the balance on your bank statement, or that's showing in your online banking account record, so the final account balance, say here at 31 March, with the actual cash that's showing in your business's records. So if the bank is telling us they have $49,880 in our account, so that's the money the bank owes us, how do we reconcile that to agree with the amount of cash we've recorded in our cash T account in the business's records? Well, we want to identify the fact that there are amounts that the bank has yet to process that we did reflect in our own records and transferred to our cash T account. And these are examples of items in this case that we identify as missing from the bank statement or online transaction record that the bank has yet to reflect, but we expect they will be reflected at some point in the near future. And notice here that the first thing that we identify is deposits in transit. So these are deposits we made where, of course, we took a check or we took an amount of cash to the bank, and the bank has yet to process that and reflect that in our account. So on the 31st of March, when we check our bank statements, say online, we realize that the amount we deposited on the 30th of March, which was only a day before, the bank has yet to process and therefore has yet to reflect that $6,450 in our account balance. So as part of doing this reconciliation, we add that amount to what is showing on our bank statement balance. The next one, on the 31st of March, which was the day where we reviewed our bank statement balance, we also deposited, say in the form of a check, $1,236. The bank has obviously yet to process that because usually checks take a couple of days for the bank to check whether the amount is available in the issuer's statement and issuer's funds, and therefore transfer those funds to your account. So we add the deposits in transit to the bank statement balance at 31st of March. We also realize that there are a number of outstanding checks. So these are the checks that we gave to suppliers, to customers, for example, as refunds. And we realize that in this case, they have yet to be withdrawn from our account. So we have three here for $589, $900, and $1,180. So the customer may have received the check, but has yet to take it to their financial institution because they may do that in the coming days, or they have taken it to the bank, but the bank has yet to process that particular check. So therefore, again, it has yet to come out of our account. So based on all this information here, based on the deposits that we expect to turn up in our account and the amounts we expect in terms of outstanding checks to be taken out of our account, I would like you to now calculate what you believe the actual cash balance is at 31st of March based on this reconciliation step. So I want you to pause this video right now. I would like you to calculate what you believe this amount is here. Right, now, hopefully you've done that. So if we look at all that information, so this is the information you were looking at before. So we looked at what was in the bank statement at 31 March, $49,880. We added in the deposits we expect to be included in our accounts, that is increase our account. We deduct the outstanding checks, which we expect customers to cash in the near future. And we end up with an actual cash balance of $54,897. So that is giving us an indication as to what our cash balance in our bank statement should have been if the bank had processed every single cash deposit that was expected and all the customers had taken out the amounts from our account that we issued in the form of checks. Right, so that gives an indication that our cash balance should be $54,897 once everything is settled up. Now, if we look at our T accounts, so that is our business's records. So remember I showed you this T account before when we drew up all the different T accounts for all the different accounts in the business. And that shows at 31st of March, we have a balance of $54,567, which is slightly less than what we believe we should have after we've reconciled the bank statement amount. Why is there a difference here? Well, let's have a look and work this out on the next slide. So, what we did in the previous step is essentially we looked at the bank statement and we looked at everything that was missing from that bank statement that we recorded in our own business records and reflected in the business's T account. Now, if we look at this information in a bit more detail, what we find in the bank statement is there are areas and particular transactions that are missing from our business's transaction record. So these are things that have occurred automatically via our bank account that we were unaware of during the period, which we need to update our own accounting records to reflect. And what we find is that we find that there is a collection of receivables of $550 during the period. So that basically means that a customer deposited an amount in our account of $550, but they didn't indicate that to us. So when we review our bank statement, we find that there is $550 that's deposited there that we didn't expect. So that, of course, increases our cash balance. We also find that when we were recording our journal entries, we over-recorded a payment by $50. So for example, instead of recording the payment, which was $100, we recorded it as $150 in payment. So of course, we actually paid $100, but we recorded it as $150. So that's $50 more than what we actually paid. So accordingly, what we do in that case is we need to increase our amount of cash we have on hand in our records by $50 to reflect the fact that we did not pay this $50. We also find two areas in which we need to decrease our cash balance. The first area is where we have a monthly service charge. So that is the bank has taken out automatically $50 from our account to pay the service fee. So that of course reduces our cash balance, and we need to reflect that in our business's records. We also find that there is a bounce check, so not sufficient funds of $220. Now, bounce checks happen for a variety of reasons, but the key reason obviously is that the issuer of the check doesn't have sufficient funds in their account to cover it, so therefore the financial institution rejects that check and that amount is not transferred to your account. So the person that issued it may not have realized that they had insufficient funds in their account, or they may have deliberately given you a bad check and therefore stolen an item. So for example, a friend of mine sells motor vehicles. He was working in a dealership where a few guys came in and purchased a brand new BMW 7 Series that's worth about $250,000, and they gave the dealership a bad check for $250,000. The dealership went to cash the check and they found that the check was worthless. Fortunately, these thieves were caught a number of weeks later when they attempted to do the same thing at a Mercedes dealer, and the Mercedes dealer called the police and they were arrested. So in this particular case, if someone gives you a bad check and you record that as a cash receipt, but then the bank indicates that you didn't get the cash, you need to reduce your cash account, so your T account balance, by that amount, which in this case is $220. So based on all that information that's included here, I would like you to now tell me what the actual cash balance should be that is reflected in the business's T account. So this is the balance prior to the recognition of these missing items and this missing information. What should the actual cash balance be after we incorporate this information? Please calculate that now by pausing the video, and then once you're finished, we'll continue on. So based on the information that we discovered when we reviewed the bank statement and discovered the transactions that were missing from our business's records, we then need to record a number of journal entries to reflect that information in our business's records, right? So if we look at this information here, what we want to specifically do is we want to add the collection of the receivable, we want to adjust for the error that was made, and we want to deduct the amounts for the service charge and the bank check. So if we look at that information that is now reflected in these particular areas here, this is how it will look in the journal entries, right? So we'll increase cash and reduce the associated accounts receivable that was paid off. We increase cash here for the amount that we over-recorded in terms of payment previously. We reduce cash associated with the service charge expense, and here we reduce cash associated with the fact that that accounts receivable that was due from the customer was in fact not paid because of the bounce check. Now, if I go back a step and I look down the bottom here, after we've taken into account these particular items, we have a final cash balance in our records of $54,897. Now, you will note that this matches the same amount that we reconcile the bank's balance to. So that basically means, as part of the bank reconciliation, we have discovered information that the bank has yet to process, which is reflected here. After they process all that, the actual balance that should be in the bank statement should be $54,897. Now, if we then turn and look at what the actual cash balance in the business should be, so what the T account balance should be, after recording these adjustments, which I showed you on slide 24 in terms of the journal entries, then you get 54,897, which is exactly the same. So we've reconciled the differences, we've agreed on the differences, and therefore the amount that the bank statement should be showing and the amount that the actual cash balance of the business shows after the different journal entries we reflect here to record the adjustments are exactly the same. So we've done the bank reconciliation, we've found out why the differences are there, we've fixed up the bank's records, we've fixed up our records through the journal entries we've recorded, and therefore we now have a record and information as to where cash is going and why there were differences between the two. And that also allows us to discover if there are items which we don't expect, for example, large withdrawals of cash from the business that we may not have expected, and therefore accordingly we need to investigate in more detail as part of our control. And many businesses have faced issues where employees will embezzle and take cash from the business over a sustained amount of time, and the reason they're able to do that is because the business is not carrying out and performing the bank reconciliation, which would allow them to discover that there are anomalies here and we need to investigate those anomalies. So for example, if we look at the case of Clive Peters, there was an employee there, an accountant, who managed to embezzle $19 million over the series of 90 withdrawals she made from this business. So she used this money to invest in property. So she amassed 44 properties by mid-2009. She also bought herself a $110,000 car, a motorbike, a vehicle for her husband, and $17,000 in jewelry. So obviously she was the accountant, so she was involved in recording the accounting information. She would have also been involved in the control process, including the bank reconciliation today. So this would suggest when undertaking these control techniques like the bank reconciliation, you want to have multiple people involved in this, so one person can't control this particular aspect, this control technique, and therefore get away with embezzling, in this case, a lot of money. And this was one of the factors that was found to contribute towards Clive Peters, that was an electrical retailer, to collapse and essentially go out of business, and all the stores were closed. So let's now have a look at the second cash control technique that we are going to cover today, which is the petty cash fund. So basically a petty cash fund is the amount that's kept on hand to pay for minor expenditures. So for example, postage, or buying coffee for meetings, or paying small bills as they arrive in cash. So while the size of the petty cash fund will vary considerably across organizations, there are three ways in which we undertake and use the petty cash fund. So while the size and scope of the petty cash fund will vary considerably across organizations, its operation involves three activities, and these are the three we're going to look at today. They are establishing the fund, making payments from the fund, and replenishing the fund. So they are the three things we're going to look at: how to set it up, how to make payments, and then how to top it up again. So let's start with establishing the petty cash fund. So in this case, let's suppose on May 1, Design Group cashes a $100 check to establish a petty cash fund and gives the cash to Sue, the custodian. So what we essentially do is we take $100 out of our general cash account and we put it into the petty cash account. So we are designating $100 specifically for petty cash purposes, so to pay those small ongoing expenses in the business. So what do we do then after we've established this fund, which is a $100 petty cash fund? When payments are made from the petty cash fund, do we record a journal entry? Well, no, we don't. What we do is we require a custodian to look after the $100 of petty cash that was originally established. What this custodian then does is if someone wants to make a small payment, generally requires that person to complete a form which explains why they want a particular amount of cash, how much they are taking from the petty cash fund, and when that person uses that cash for that purpose, they bring back the form, exactly how much they spent of that cash, and they attach the receipt to that form that relates to what they spent the money for. And so therefore the custodian can then have in their drawer where they may keep the petty cash fund, the cash that remains, including the change that the person brought back that used the funds in the business, and the form that explains the amount of cash that was used up and is therefore missing from the original $100 petty cash fund that was established. Now, if the custodian identifies that they need to replenish the petty cash fund, so they have $15 in this case remaining in the petty cash fund, and so therefore they want to top it up. Well, the first thing that they're going to look at is they're going to look at whether or not all the receipts that they have in their petty cash drawer, which may be a locked drawer at their desk, matches the amount of cash that's been used up. And in this case, we have postage for $25, office supplies for $45, and other things for $13. And all those things add up to $85, which is good, which basically means that we have used up $85 that exactly matches the cash that is missing from the petty cash fund and the amount we need to top it up by. So what do we do in order to top it up? Well, what we do is we record this particular journal entry. So we record all the associated expenses that the petty cash was used for, so postage, supplies, and other expenses, and we reduce the cash balance by that amount. And that cash reduction here is obviously being put in the petty cash drawer to replenish it from $15 to $100, which was its original balance. What you will notice in this journal entry is we have not touched the petty cash account. So remember, if we go back to this slide up here, we recorded $100 debited to the petty cash account. That account stays the same because remember, when we made payments from the account, we never ever recorded any journal entry. So therefore, the $100 petty cash account balance stays at $100. So when it comes to replenishment here, of course, we replenish the petty cash fund by taking cash out of the general cash account and putting it into the petty cash drawer, which brings it back up to 100, which is its original balance, which stays in the petty cash account. Now, sometimes what you will find is that when you add up the value of all the expenses and uses of the petty cash, which here again are $85, they don't match the amount that should have been used up in the petty cash fund. So here we'll see that we only have $13 left, which means that we need to replenish the fund by $87, which of course is more than the value of these receipts. So what's happened is someone has taken some petty cash, they've spent it on something, they've lost $2 change, and therefore the amount in the petty cash drawer is $2 less than what it actually should be. So how do we account for this? Well, what we do is we use an account that's called cash short and over. So what that essentially means is that this is the cash that's either short which it is in this case. We're short of $2, which is why it's debited. Or over, which means we may have more cash than what we expect. So for example, someone brought back too much change or took change out of their own pocket and put it in the drawer, which means in effect, we don't need to replenish the petty cash fund by the value of all the expenses that are associated with the receipts in the petty cash drawer. So accordingly, in this particular case, given that we are missing $2, in addition to all the expenses that was incurred, then of course we need to take $87 of cash to bring it up from $13 to the $100 original petty cash balance. So the question I would like you to do now is this one. It says that a $200 petty cash fund was established on February 1. On March 1, $20 is left in the fund. The receipts are $110 for postage and $72 for supplies. What's the journal entry to replenish the fund? So if you could please attempt this right now. So how did you go? And what answer did you get? Well, let's have a look at the information here. The first thing we have here is we have a $200 petty cash fund was established on February 1. The total value of what we have used up from this fund based on the receipts is $182 used, at least from a receipts perspective. Now notice that we have $20 left, which means that the actual reduction in balance is $180. So notice the difference. We've used up $180 from the cash in terms of petty cash funds, but the actual value receipts is $2 more, which is $182. So what happened? We effectively have $2 more than what we should, which means basically someone has brought back too much change and put it in the petty cash drawer. So how do we record the replenishment of the fund? Given that we only need to replenish it by $180, just take it from $20 to $200. This is what we need to do. What we need to obviously do is we need to credit cash by $180. Okay, so that's certainly what you need to credit. You need to, of course, recognize both expenses, so the $110 in postage and the supplies of $72. And you need to do something with the $2. And in this particular case, the $2 was equivalent to cash over and short. Right now, in this particular one I've highlighted, I'm happy with the accounts, but I'm not happy with the debits and credits here, because essentially what we're doing in this particular case is we are debiting 110 plus 72, which is 182, plus 2 here, which is 184, and we're only crediting 180. So as you know, that doesn't work. So this one is not the right answer, okay? So we're going to get rid of that highlighting there. So if we look down at the following option, so we have debit postage for 110, we have debit supplies expense for 72. That part's good. We have cash that's credited for 180. That's good. And we have cash over and short. So in this particular case, we had $2 cash over what we should have had. And so we credit cash over and short there, which means that the debits here of $182 in total match the credits of $182 in total. So the correct answer is the last one. Debit postage expense 110, debit supplies expense 72, credit cash over and short 2, credit cash 100.